Morning and welcome to 5 Minute Finance. I'm Matt Stranix, and today Luke Chapman and I will be discussing modern portfolio theory and why it should be important to you as investors. Good morning, Luke.
Good morning, Matt. One of my favorites, modern portfolio theory, is something that we discuss with all of our new clients because risk-adjusted return is just a fundamental part of our investment management philosophy.
Great. So why don't you dive right in? Go ahead and give us kind of a foundational understanding of what modern portfolio theory is.
Okay. Modern portfolio theory, quite frankly, is another way of saying you need to diversify. On the screen, you're looking at what is called the efficient frontier. On the x-axis, the horizontal axis, you're looking at standard deviation or measurement of volatility risk for an investment, going from left, which is no risk, all the way to the right, which is extremely risky and or volatile. On the y-axis, the vertical axis, you're looking at the expected annual return for the investment. The bottom is very little to no return, while the very top is very high annual return. The curved line in the middle represents the perfect balance of amount of expected return and amount of volatility risk needing to be taken to earn that return.
All right, so I want to stop and just make sure our at-home audience and myself, quite frankly, are following along here. The blue dot falls on the line. So this is considered an efficient investment because for 8 units of risk, I should be expecting 6 units of return. Is that correct?
You got it.
All right, so Luke, I have to ask, why don't I just try to find an investment that has 1 unit of risk and 10 units of return?
You want to take no risk and experience all the returns. Don't we all? That just doesn't exist. And is why we review the concept of risk versus reward, and specifically the efficient frontier with all of investment clients to set expectations with reality. Now, I am not saying that some investments may outperform or underperform compared to the level of risk. That's why investing isn't guaranteed. And frankly, that's exactly what is happening. Using the efficient frontier as a comparison tool prior to investment, we can anticipate how a particular investment, or more commonly, a mixed portfolio, could perform, and then also be able to measure actual historical results compared to the original expectations of an existing portfolio.
Okay, that makes sense. So why don't I find an investment that's always on the efficient frontier, and I'll hold that one investment in my portfolio?
Let me know what that is, bud. The reality is to fall on the efficient frontier, more than likely you need to blend a blend of investments. It's about strategically selecting some investments that we anticipate to be riskier, but efficient and or outperformers, as well as some investments that we anticipate to be less risky, and the combination achieves an overall portfolio design of maximizing risk-adjusted return. For example, if we held all the blue investments in a portfolio, the portfolio itself would be represented by the red dot.
Great. What else do we need to know about modern portfolio theory and the efficient frontier?
Well, Matt, if somebody is looking for, say, 3 units of return per year, they really shouldn't be taking more than 3 units of risk. That is inefficient. They only need to take 3 units of risk for an expected return of 3 units. On the flip side, if somebody is comfortable taking on 10 units of risk in their portfolio, they should expect 7 units of return. However, if they're only earning or receiving 3 units of return while taking 10 units of risk, that too is inefficient.
So what I'm hearing is that there is some correlation of risk versus reward when it comes to investments. For an investment that has substantial risk, we may very well experience a large loss or a substantial gain. Meanwhile, an investment that has very little risk, like a money market fund, will likely provide a more stable but low return.
That's exactly right, Matt. This is why it's so critical that this information is not taken as general advice that applies to everyone, However, each person, family, and business has different investment goals, objectives, and timelines. So it is important to work with a professional to help craft and review a strategy that is customized for you. And again, just as important to be consistently reviewing your portfolio to maintain the proper balance along your investing journey.
Luke, it's always a pleasure. Thank you again for your time this morning. That wraps up this episode of 5 Minute Finance. New content is released on the first and third Wednesday of every month. Be sure to like, comment, and share to help spread the financial education. Thanks, everybody.